Yeah, I think that most folks expect a lower bracket, and that doesn't develop the way they anticipate.
I'm seeing them retire with very few deductions, and if they've been socking it away in 401ks or just tax-deferred plans, I see them retiring with very few deductions and 100% taxable income.
I see that all the time with people who have created wealth and done the right things with their money throughout their life. By the time they retire, they're actually making more money than they did when they were working.
Well, we had a couple quotes there from a few of the CPAs that we've interviewed on our podcast, just to kind of kick things off here. But our question today that we're answering is, should I defer taxes or should I pay taxes now? And we kind of want to get into, how taxes have been historically, get into kind of a real life example, and kind of tackle this question.
Well, and I think those quotes are important because that's what's happening. Those are people that are, in the, what do they say? They're in the
moment.
Come on.
They're in it.
Yeah.
They're really in it.
You know what I'm saying?
Yeah.
Like they're in the day-to-day. They're there working with people.
They're in
on
the trenches.
front line. In the
trenches.
All right. So they are in the trenches, and they're working with people every day that are, dealing with taxes. And so it's interesting to note that they are seeing people retire in higher tax brackets, and it's not really favorable for them. And we're going to talk about why that is. And anyway, so going into that, we're gonna post this graph, but just from a historical tax, standpoint and what taxes have been like in history. Man, I'm struggling with words today. Anyway,
You'll get it.
It'll come. But we'll post this graph. It's interesting to note that we are in some lower tax brackets than we've been in the last 100 years. For years, they were highest marginal tax brackets were in the 80s. I mean, they were high, and they've come down significantly over the years. And so have other tax changes and what you can deduct and all that kind of stuff. But we really are in some of the lowest tax brackets that we've been in. And so to kind of clarify the way to win, so to speak, in a deferred account of some kind, a 401k, an IRA, the goal is essentially to postpone the taxes of today when you're in a higher tax bracket and take them out later in a lower tax bracket. If you don't do that, you may need to reanalyze what your tax strategy is, and that's what we're going to talk about today: reanalyzing that and what may work.
So, yeah, to kind of go back a little bit, even to talk about this history, I think that the tax deferment movement started with the introduction of the 401k. People were in very, like you said, Jake, high tax brackets, and so they were looking for ways to eliminate those taxes now and hopefully somewhere down the road be in a lower tax bracket, which was kind of the advent of the 401k, the shift from pension plans, another podcast topic. But anyway, so the advent of the 401k really started people on this movement of deferring their taxes. And for some reason, even though our tax rates have gone down significantly since then, we are still seeing the majority of people use a tax-deferred vehicle. And that, to me, is a little bit kind of just following the crowd a little bit, kind of as going along with what everybody else does.
Right. Well, and to just talk a little bit about then to now and then the future here, historically tax brackets have been lower. Now they're in a position, or have been higher. Right. And now they're lower than they've been. And looking at the economic situation that we're in the United States, it's hard to foresee taxes getting lower.
Right. When you start taking into account government spending, our debt as a nation, our future liabilities, Social Security, all of these different problems that we really have to take care of. I don't know how they'll do it, but somehow that revenue is coming from us, the taxpayer. I mean, that's the only way it's going to work. And maybe they don't go up for certain, whatever. Maybe who knows what'll happen, but it's my guess that they're not going to go down. And that's the key here. Is it going to go down? Because if it doesn't go down, most people are probably going to find themselves in a higher tax bracket. And that kind of leads to the individual, scenario. What is your tax situation individually like? And for listeners out there, think of where you were 10 years ago. Were you in a higher tax bracket or were you in a lower tax bracket? And for most people, and maybe you've had some rough spots and you're not even working. And that, there's scenarios out there where you're not, progressing how maybe you want to. But the idea is, as you get older, as you gain more experience, more knowledge in your field, your salary is going to go up. And that's the goal. Make more money in the future than I'm making today. Everyone has that goal. And, so if you start to think about where you were 10 years ago, 20 years ago, wherever, whatever age you are, if you're deferring all those taxes and really you're going to be making more money in the future, then what was it all for, right?
Well, and a couple other lifestyle things to look at are, if you have children in your home, when you get older, hopefully they've moved out. Maybe you got them living in the basement, but hopefully they've moved out, and so you no longer have a deduction for those dependents. And maybe you have your home mortgage paid off, so you no longer have a deduction to pay the interest on your home mortgage. So what we're trying to say is that there are things that happen and that should be, I guess, goals of everyone's life to make more money and to
get your home paid off,
right? Help your kids move on with their lives that will have an effect on your taxes.
Right.
And a lot of people don't tend to take those into account.
Well, another one that we don't take into account very often either is inflation. Just if your income was just keeping up with inflation, then you're going to be bumping up into higher tax brackets. It's just natural, And so all these individual scenarios where your personal taxes should go up, if you are deferring your 10, 15% taxes today to 30% in the future, you may be costing yourself a lot more money than getting rid of them today and putting them in. And that's the other thing. I mean, you got to have the option of getting rid of those taxes and then having that tax-free environment. And that's why we talk about life insurance. That's why you'll hear a big buzz about Roth IRAs. Same idea. We're trying to best suit our financial strategies around what taxes are going to be. And
right.
So,
take some of the risk out of what if, all these what ifs for the future that could be affecting you and your tax bracket in the future. Taxes go up, you don't have deductions. There's all these what ifs, and so that's really one of the reasons why we're kind of talking about this today is because I don't think people take into account those what ifs. They just kind of do what they're told to do.
Well, because today it feels better. If my taxes are X and I get them a little less than X, I feel good. I get a little bit bigger refund. That's what a lot of tax planning's been. How do I this year pay the least amount of taxes? That's a poor way of handling that.
Short-term view.
It is. You got to be able to look at your overall taxes. I don't care if I pay more today if I'm going to pay a lot less in the future. And then take into account getting taxed on Social Security, getting taxed on all of these other forms of income. It becomes very excessive. And that's why a lot of people today are struggling. They're working longer. They're working into years where they have to take distributions. They're getting, paying higher taxes on these dollars they've postponed. Their Social Security is being taxed. It's not a great scenario. And so, and that being said, there are probably situations where deferring taxes is going to be beneficial. You might luck out and land in a scenario where you're making less and you still have a lot of deductions and it works out, and that's great. But my opinion is there's far less people that fall into that scenario than
in the CPA's opinion.
Oh, yeah, and the CPA, that refer back to them. They're the ones that see it.
And there's a lot of economists out there that feel the same way.
It's all over.
Just based on our government spending, our government debt, it's pretty clear. Yeah. But anyway, so we kind of want to look, we took two scenarios, someone that makes money, two people that make the same amount of money. One person decides to defer or postpone the taxes they pay, and the other decides to pay the taxes now.
Yeah.
Right.
And so we want to kind of look at those numbers. If you don't have the chance to see this podcast on our website, we're going to try and post these numbers. If you're just listening, pay really close attention right now to these numbers. Might be a little
rewind.
Listen. And so we're using, in 10-year increments here. The first 10 years, then the second 10 years, and then the third 10 years, and then, retirement. So what do we say? They're about 40 right now. You know?
Well, let's just assume 30 years down the road is retirement.
Yeah.
You know, and we call the first guy Frank, the second guy Shank. Frank is the guy who pays taxes now, and Shank is the guy that pays taxes later. And by the names, you can probably tell which one we think is better than the other. But anyway, they're both essentially saving $5,000 a year, earning 5% interest. We're just going to simply look at how the taxes affect that scenario. Years 1 through 10, tax bracket is 10%. Years 11 through 20, 20%. Years 21 through 30, 30%. Very simple. Nothing extremely difficult to understand. And so essentially what's going on is the first 10 years, they're earning less money, like most people out there. They're paying 10% in a 10% tax bracket, and the account value for Shank is $66,000. Okay, after that 10-year period, $5,000 a year, earning 5%, deferring all the taxes. So he's got $66,000, whereas Frank only has $59,430. Okay, so years 1 through 10, who's looking better?
Yeah, well,
what do you think?
Shank's pretty
smiling.
excited. Yeah, he's looking over at Frank saying, "Hey, you're doing things all wrong."
Yeah.
Okay. So let's move on. Years 11 through 20. So they made more money. They got bumped up to a higher tax bracket. Now they're paying 20% in a 20% tax bracket. Okay, so at the end of that, the 20-year period, Shank's got $173,000. Frank's got about $149,000. Okay, so again, Shank is looking at his account, comparing it to his brother Frank, and going, "I'm doing better than you. You got to keep up."
Right.
Okay, so we keep going. We get to year 30. Again, from years 21 to 30, they get bumped up to a 30% tax bracket. At the end of the day, Shank's got about $348,000 in his account, and Shank's got about a little under $290,000. Okay, so now let's look at what happens. They are at retirement, and they decide to retire. Okay, so Frank, he has essentially deferred, or he has paid all his taxes. So now his account balance is what it was, what we just said, about $289,000.
Right.
Okay, but Shank now has a tax liability because he's deferred all his taxes, and he has moved from a 10% tax bracket up to a 30 along the way through his working career. And his ending retirement value is about $244,000.
So he's got a portion of that really that's his, and then the postponed taxes, which are now taxed at 30% as opposed to what they were previously, that really hurts him in the long run. So Frank's got $289,000 and Shank's got $244,000. Now,
who's smiling now?
Yeah, who's smiling now, right? And it's a substantial difference, and escalate that and add more value, saving more, and those become bigger gaps the more you're saving, obviously. But really, what we see is that postponing those taxes becomes a greater liability in the long run in that scenario. Now, let's say that Shank's goal of making less money in the future actually happened, right? And he's in a 20% tax bracket instead of a 30% tax bracket, right? That would be the argument I would make to make this a real scenario, right? Maybe for some reason he's in a lower tax bracket. Like we've seen and heard, probably isn't the case, but a lot of people still think that might be the case. Let's assume that he is. He bumps down into a 20%. His account value is still only $279,000, whereas Frank is at $289,000. So Frank still comes out ahead
by paying his taxes along the way.
By paying his taxes along the way. And so even though Shank may be in a lower tax bracket, probably not the case for most, he still comes out behind when he bumps down into a lower tax bracket.
Yeah, and it's interesting to me to look at this because I feel like our society is all about instant gratification. We're all about seeing our account balance grow and grow and grow. We want to see that significant growth. We have a very, like we mentioned before, a very short-term outlook. Right. And so Shank in this scenario is just loving life all the way along until he gets just pounded with these taxes. Whereas, Frank kind of understands a long-term outlook is, paying my tax along the way. I'm going to be in a higher tax bracket most likely. I want to pay those along the way, and he ends up benefiting from it. So I think you really, when it comes to just finances, when it comes to saving, depending on the goal, but most people have a goal of accumulating as much money as they can in order to live off of and pass on. You got to have a long-term outlook. You can't look at this, like Jake said, every year you want to pay the least amount of taxes as possible. Well, maybe that's not the best idea. Maybe you want to pay the taxes you need to and then never pay them
this
again.
is a $45,000 difference, and whatever percentage difference that is, apply it to your scenario. But that's a substantial amount of money, and given the fact that people are having to work longer for other reasons, investment accounts not performing, every little bit counts, and so it's just my opinion that not even because there's a lot of reasons. The mortgage deduction that we talked about, the kids being out of the home, no more exemptions for those types of things, the economy, inflation. There's a lot of reasons why you're probably going to be in a higher tax bracket. But even more than that, I personally want to be. And that's kind of my goal, is to make more money every year that I live, as opposed to making less and trying to find ways to make less.
Yeah.
That to me is not a scenario I want to be in. I want to be inclined to make more and more money. So.
Sure. Yeah. Well, and I just really want to mention real quick, I know when we were talking about this earlier, I know, Jake, you kind of mentioned that, given the options, this, the tax deferral looks good, because I don't think people understand that they have other options, and they don't take the time to study the other options. And I know that's one of the things that we're proponents of just understanding what all your different options are and what they're going to do for you.
Well, you go get a new job, you're automatically enrolled in your 401k. You really don't have a lot of reason, number one, to look around because you haven't experienced anything bad enough, But it's just there's not enough, education, not enough options. And anyway, the goal here is, rethink your tax strategy. Even though it may cost you a little more today, is it really costing you more over the long run? And that being said, comments, questions, info@becomingyourownbank.com, or give us a call at 1-800-321-1636. Any comments? Any last thoughts?
No, I think we're good. We'll post everything up on the blog.
Yeah, make sure you check it out, and we'll catch you next time.